Welcome back to Trading Hour. Well, as promised, Nilesh Shetty, Portfolio Manager of Quantum Advisors, joins us now to discuss market fundamentals and his top sectoral picks. Thank you so much, Nilesh, for joining us. First up, you've seen quite a bit of a correction and a bit of a bounce back as far as the mid and small caps are concerned. What are you and how are you assessing the market at the current levels?
Yeah, the correction is not a surprise at all. It was long overdue. It still doesn't reflect retail selling. Given the rally that has happened and given that a lot of the money has come in over the last sort of 2 years at valuations that have not made sense, I'm assuming a lot of the mutual fund investors especially are staring at losses in their mutual fund NAVs, especially in the small and mid-cap funds. At what point does that reverse and you start seeing selling? And that has happened in all previous corrections, including during 2008 and including after COVID, where retail investors start selling or redeeming from mutual funds, which triggers another set of correction. So I think that leg is still pending. So there could still be a lot more pain. And you have to understand, in that bucket, liquidity is not that easy. It's a very shallow market. And if you're trying to liquidate stocks, you don't find buyers at the other end. So there is a stabilization right now, but I think there is significant pain left in that bucket still. I think the larger cap names are a lot more reasonably valued. And I think if you're a long-term investor, especially if you have a shorter term horizon, I think you should be careful in that small and mid cap space. I think there could be more correction underway.
More correction underway. How deep could the correction go, to your mind, Nilesh? At what point should people start deploying money at an index level?
When you look at the mid-cap P, when we looked at the forward estimates, it still trades at about 37% premium to the sensex trailing price to earnings multiple. So, you have to be careful. There's no reason for that bucket to trade at a significant premium because most of the company managements there are not that great a quality. And they tend to be a lot more volatile in terms of upcycle and downcycle in terms of PE expansion. So in a bull market, they expand quite materially above the sort of large caps. And in the correction, they correct quite materially and move actually lower than the large caps. So there could be a price correction, which looks likely at the moment, but there could also be a time correction where they underperform the large caps by a fair margin over the next 2-3 years. But that's difficult to say. I think optically it looks like another 15-20% is possible in that bucket quite easily. But again, there's no way of forecasting it. It highly depends on how the retail investors react at the moment.
Nilesh, at the end of Jan, if we aren't mistaken, you were close to 14 to 15% holding cash in the portfolio. So do you see incremental opportunities? Are you comfortable continuing to hold cash? And where are you seeing those incremental opportunities to add?
Yeah, for us, the cash is always a residual of the strategy. It's just that we've sold out of companies and we've not found new names. We are now getting some names coming through and getting closer to where we would like to buy them. So the strategy follows a value style, and we have a strict limit of where you would like to enter particular companies purely on valuations. So they are getting closer. They are within 10% range. There are a couple of names where you would like to increase weight, including in IT companies, where we've seen some correction in valuation. But otherwise, it still remains around that 14-15%. It has not materially changed.
You want to increase your weightage in IT companies? Which ones, Nilesh, attract you right now? And any thoughts on Hexaware, the one which got listed yesterday?
Yes, I will not be able to comment on specific names, but our focus has always been sort of large cap IT names. We've not been sort of great allocators in sort of especially tier 3 IT names. It's always been companies in the top 5 or top 6. I think scale plays a big role in that sector. And I think the smaller companies tend to do well sporadically, but a lot of them are not able to scale up eventually. And they're not able to match up to the big players. So our allocation, if we increase, will be in the larger cap names.
Nilesh, coming back to the financials, you said that you do see some opportunities there, especially in the larger names. In terms of financials, banks, private, public, NBFCs as well as MFI space, where are you seeing the opportunities, or what is your state of preference?
So our largest positions remained in large private sector banks. Now, they've actually missed the entire rally over the last 3 years. They've actually been silent observers, despite sort of fundamentals improving quite materially, including on the balance sheet side. And of course, you're waiting for credit growth to pick up. There have been a few regulatory headwinds, but apart from that, in terms of valuations, they are trading at a significant discount to their long-term averages, and the long-term story is still the same. It's not materially changed. Credit sort of has to grow at about 2x of real GDP growth, and if India is growing at sort of 6.5%, credit for the sector will grow at sort of 12-13%, and these banks will tend to grow faster than that. So at least that is where we find opportunities in large private sector banks. And increasingly, actually, we found opportunities in the savings side of the theme. So we found insurance companies a lot more cheaper in terms of valuations. We found asset management companies which have sort of come to a buy limit where you added. So currently, we have about 40% in the BFSI space, but a lot of the new names actually came from the savings side of the household balance sheet.
Okay. Yeah, sorry, go ahead.
Nilesh, what about utilities? Quite a few of the PSU stocks, especially in the power space, in the oil and gas space, quite a lot of them have seen significant correction, in some cases 30-40% from the peaks. Do you like any of these names, government-regulated entities? Would you look to add them in the current fall?
Yeah, thermal power utilities, they tend to run on a fixed sort of return on equity model. So it's very surprising for a company that makes about 15% ROE, why it should trade at 3 times price to book or 4 times price to book. I mean, you're making a sort of at 3 times price to book, your yield is about 5%, which is much lower than a long bond. So it's a space that we've not allocated to. We have exposure to gas utilities, where we think there is a story there, where gas penetration continues to remain low, and volume growth should be a lot higher, given the transition that we're experiencing from the thermal side to sort of gas. So their valuations, we think, are a lot more reasonable, and we have allocation there on the gas utility side.
Thank you, Nilesh, for joining in. That's a cautious voice on the market. They hold 14-15% in cash, and they're saying it's not unreasonable to expect another 15-20% kind of a correction in small caps. That's subject to if retail investors now pull the plug and perhaps stop investing in the markets or withdraw their money. But let's move on to another important story. BJP